Welcome, everybody, to another episode of the Good Deeds Note Investing Podcast. Hope you're all doing well today. Today, I brought on a special guest. I brought on David Chan from FarmTogether. And FarmTogether is an opportunity most of us probably never heard of. And one of the reasons I wanted to bring David on is because as note investors, nobody's ever heard of what we do. And it's an interesting investment strategy. And I want to have him on to kind of share the strategy with others, because we all look to diversify our portfolio, and it's very important for people to diversify their portfolio. And David's got a really interesting investment concept that we have. So, and along with that, just to introduce David, David has been with FarmTogether for 5 years. He's worked in a lot of private equity side, AmeriCapital, Prudential Agriculture. He also got his MBA from Harvard. There's my little Boston accent coming in, because I'm as many of you know, Massachusetts boy, deep down inside, spending 35 years up there. So David, how are you today?
Doing well, Chris. How are you?
Good. So my first question though is, you went to Harvard and now you're kind of in the New York area, correct?
Yes, I'm a New Yorker, so,
okay,
I think we should stay clear of that topic.
Okay, we won't even go there. So I'll give you all the baseball accolades, but I can take the football ones for the time being.
I'll give you this. I'm a Met fan, so I actually do root for the Red Sox when they play the Yankees.
Okay, well, I think actually that might be a bigger dagger in my heart, because I was 10 years old or 11 years old when Bill Buckner had his faux pas there on the, Actually, I still blame Bob Stanley, though, because they had the one-run lead and he let him tie it up before Buckner even blew it. But so good. So, David, why don't you start out by just telling us a little bit about FarmTogether?
Absolutely. So FarmTogether, really what our mission is to increase access to direct investments into U.S. farmland. We think farmland is arguably the best asset class for capital preservation. And in the past, it's been very, very difficult if you're just an individual investor to gain access and add farmland to your portfolio if you don't have several million to allocate towards the space, because it's quite simply hard to find farms that are operating and profitable under that in size. And most folks don't know how to farm. And so there's also a skill gap and a geographic constraint too, because of course, if you're in the Delmarva, or if you're in New York or Boston, most of the farms in the U.S. are not near you, or at least none of the big ones. So we are leveraging crowdfunding, which is a form of being able to syndicate a deal to many different equity investors and ultimately reduce the minimum investment size. And so we're leveraging that to open up this asset class to a much broader cadre of investors.
Okay. So I'm curious, because a lot of people who are listening, we invest in, land that has property on it. And with farmland, granted, you've got agriculture on the land, but it's also like a production business. So I'm curious, how does farmland investing work, and how does it, tie together with the people who are actually doing the farming, out of curiosity? Are you just investing in the land, or is it actually the farming component too?
Yeah, absolutely. And maybe I can also just move ahead a little bit here.
Oh, yes, that's right. I'm sorry. You have your slides here that you can go
definitely don't need.
Well, yeah.
Definitely don't need more on me. I should say though, I have not been at FarmTogether for 5 years, because FarmTogether is only 3 years or 2 years old.
Okay, I'm sorry.
But no worries at all. But in an early stage world, 1 year does feel like 5 years. So emotionally, it does feel like 5 years. But so the way, let's see here, the way it really works, and I'll just pull this up to show a little bit more about performance of the asset class in the past. It is a production business. So if you are familiar with real estate, I imagine many of listeners are, real estate delivers basically a dual return stream. Part of it's going to be income-based, the other part is going to be appreciation. Farmland works the exact same way. So the income stream can either be through the form of rental income or lease income, where you own the property, but you lease it out to a tenant. The tenant is going to do all the farming. The tenant has full exposure to the performance of the property. And so if yields are high and prices are high, the tenant is very happy. If yields are low and prices are low, the tenant is not happy. And your upside and downside is pretty capped. You're just collecting that rental income. The other form of an income stream could be through operating income. So rather than renting out the land, you could pay an operator to do the farming for you, and you have the exposure of both yield and price. And so if yields are high and prices are high, then you're the happy one, and vice versa. So it's a bit riskier, but we do see higher returns, higher yield to compensate for that risk in what we call direct operating models. And then finally, there's an appreciation component. So, and this is one of the, I think, strongest attributes of farmland. If you think about where all these goods go, especially, if we're thinking row crops like corn and soy, these products go both into feed and food. So they're used in growing beef cattle and chicken and pork. They are used as food themselves for food grade commodities. They're used as ingredients. They go into the production of so many consumer packaged goods. Your backpack is probably made out of a portion of corn. The pen you're writing with probably has some corn in it. It's actually astounding how many commodities and products goods like corn and soy go into. And so because of that, it tracks inflation remarkably well. In fact, I think we have here, just for comparison's sake, let's see. Well, it's also, yes, we could also talk about the diversification, but I don't know if I have the slide I was hoping for, but I believe the correlation between farmland and inflation is about 0.78 or 0.8, and basically one would be perfect. So tracks very closely to inflation. So because of that, your appreciation is a pretty known factor. If you underwrite conservatively, you should be able to hit that number. And so we love the asset class for that reason. And then, of course, for diversification, which we can come to in a bit, but this slide shows a little bit more about that. But it is an asset class that, very much so follows its own direction and doesn't really take cues from the broader macro.
Okay. One thing, and again, I kind of threw the curveball and had you jump around the slides. If you want to go back, because one of the things, too, is there is a very positive social impact with this. And that's one of the things is kind of with my podcast, a lot of people today try and do some social responsibility. It's very important in today's society. And this seems like it just kind of fits right down there because you're saving farmland from development and having it done overseas. It's being made here with the COVID crisis going on in this country right now. I think you're going to see more of a push towards, more production here in the United States. That was one of my questions that we can talk about later, as well as I think a lot of people can see inflation is going to be coming in the future. So, I have no investment or no anything in this. I'm just, thinking in my head, wait a second, he's talking about inflation is good and what's going on in the world. So this is something people should probably start thinking about.
Absolutely. We think that this is definitely an asset class that has a outsized potential to drive impact. And it's something that we care very deeply about, and we are intertwining in every part of our investment process, from our sourcing and our underwriting to our management. So here, just thinking about, of course, impact and sustainability are broad terms, but we like to, sort of use the UN's Sustainable Development Goals as our North Star. Ultimately, if you are thinking about impact, it should lead back to one of those goals in some way, shape, or form. And so just thinking through ESG and the social, economic, and environmental benefits that could be created through sustainable farmland investments, you see 8 of the 17 UN Sustainable Development Goals are covered here, ranging from, of course, zero hunger, good health and well-being, to other categories like responsible consumption and production, sustainable cities and communities, and also considering life on land and decent work and economic growth. If you think about farmland as an industry, from the labor that's involved on the actual fields, all the way up to the quality assurance that's required for a good that ultimately enters our bodies, it is just tremendous what the talent pool is responsible for, and also how the value that they bring to the broader society. And so, of course, with responsibility could come consequence. And so with poor incentives in place, without thinking through and having a proper stewardship and sustainability framework. This could be an asset class that could erode the environment. It could do more harm than good. And we've certainly seen that in some parts of not only the US, but the world. But FarmTogether, we absolutely have no tolerance for that. We have adhered to a strict a sustainability standard, and we're actually in the process of formally subscribing to a standard that will be audited by a third party, because we think third party assurance is very important, and reporting and setting metrics and accounting is also equally important. So we're very excited to be rolling that out and are looking forward to doing so this quarter.
Cool. So if you could jump back, and again, kind of, I think it's in order now. You had the slide with some returns, and then it briefly talked about, I think it had 10.5% unlevered returns on there, as well as, oh, by the way, I think if you have a disclaimer, if you want to, mention that.
I always scroll past that too fast.
Yeah.
I think our attorneys would yell at me. But yes, this is the typical disclaimer.
So people, pause your screen, read it. We're not going to read it to you, but basically it's confidential, privileged information. We're not giving investment advice, all the typical hoopla. You're not suing any of us, so don't think about it. That's basically, we're not telling you anything. We're just talking about farming and FarmTogether. So that's basically it in a nutshell. It's kind of
no pun intended.
Yeah.
All right, so let's go back to the returns here.
Yep.
Yeah. So over a 45-year period, and actually we had updated numbers. I should have updated the slide, but it's been a very steady, high yielding, especially on a risk adjusted basis asset class. 10.5% annual average return for that period. Mind you that there were several global events through those 45 years that were significant. We had the hyperinflation of the 1980s. We had a Russian trade embargo in agriculture in the 1980s. Of course, we had the dot-com bubble burst, the great financial crisis. So, this is not we're not slicing and dicing to find the best of years here. This is a pretty broad spectrum.
Yeah, and out of curiosity, has it been, if you invest in tech stocks as an example, you could have 40% one year, -10 the next, then 2, then -6, then 30. It's a roller coaster ride. I mean, your risk, and your, that delta, my brain is fried right now thinking of the term I'm trying to use. But, it's, goes ups and downs, where I'm just curious, is this more kind of like mutual fundish, which is more consistent, basis, or over that 45 years? And again, taking out the impacts from world turmoil from that perspective, or is it really, or is it weather based? Is something I was thinking too.
There's a number of different factors. So, weather in one given region, it's local, but weather could certainly play a role. Like an idiosyncratic event like a flood or a drought could certainly affect a given property. But, as a whole, if we look at U.S. farmland as in aggregate, we find it to be very stable. So the second bucket here is, I think, captures what you're talking about, Chris, which is the volatility of the return. So
that was the term I was thinking of.
Yeah,
it's
exactly.
right in front of me.
So, how much does it swing, and, what's a roller coaster ride like for us to get those 10.5% annual average returns? The volatility of the index over that same period, or of the asset class, has been 6.4%. And so if you want to think about what does 6.4% mean, if we look at the S&P 500, those numbers are basically flipped. Over that same period, the S&P 500 delivered about a 7.5% average annual return with a volatility of closer to 13%. So, we love that, and it's hard to communicate, but we always think about, for every basis point that you're getting in return or yield, how much volatility, how much risk are you taking on to get that? And so, not to get too academic, but for any fans of the Sharpe ratio, look at the Sharpe ratio in farmland. It's incredible.
So I was going to say, the volatility, trying to dumb it down, is basically the standard deviation, either single or double, I forget, standard deviation. So essentially, a high majority, high percentage is going to be between 4.1 and 16.9%, from the 10.5, 6.4 up and down, is if I'm remembering my finance class properly.
Yes.
And the other thing too, that's interesting that you talk about on here is how it's uncorrelated with other assets, which means it's not tied to other assets, meaning if the stock market takes off, this doesn't care. If the housing market crashes, this really doesn't care. A correlation of 0 means like it's similar to if it snows in Massachusetts and you're in Florida, it don't care. It don't matter to you, So that's kind of, what those numbers mean. So that's pretty interesting as well.
Yeah, we have that breakout. I'm going to go a little bit further down here, but right here. So this is the correlations. This is honestly, I think, one of the most interesting perspectives of the asset class. Looking at how it's related to other asset classes, it's actually negatively correlated with U.S. stocks. The S&P 500 is our benchmark here for stocks. Negatively correlated with the U.S. Bloomberg Barclays bond aggregate. Almost a 0 correlation with gold, and only a moderate relationship with real estate. And so, this is, in our view, one of the best diversifiers for a portfolio, because you have negative correlation across the 2 most major asset classes. For what you would consider to be a competitor, I think most folks think of gold as a competitor because it is an excellent inflation hedge. You have little correlation there. And then real estate, which is in the same asset allocation bucket, real assets, even for real estate, there's only a moderate relationship. So we think it's actually quite astonishing just how uncorrelated of an asset class farmland is.
Yeah. So now, we've talked some finance and numbers and so forth. Why don't we roll a little bit more into defining kind of, what it is, a little bit more of farmland, and, because again, not many people know about this. So I'm just curious, what's been the push for this, or, why, what's the, the next, where do you think this is going? And I'm curious because same thing with notes. Before I got into it, I never heard of really investing in farmland. So I was just curious, it seems like, this is probably something new and coming up. It seems like it's also been around for a while, but I'm just curious, from that perspective, the size of the market and some other things along those lines.
That's what I find to be the most surprising aspect of the asset class. That we'll speak with investors about farmland, and they'll say, "Oh, I need to get used to it. This is all very new. This seems like a very esoteric asset class." And I think to myself, people are investing in Bitcoin and cryptocurrencies and all these new instruments that we don't really understand yet, or at least at the time didn't understand. And yet farmland, which arguably I would say is the oldest industry, the oldest asset class known to man, because we had to have it here in order to get here. It surprises people. So anyway, it is by no means, it does have a new flavor, because I think it's just been so inaccessible in the past. But the asset class has been around for millennia. And so what we're seeing now in the U.S. is actually quite interesting. The average age of the U.S. farmer is now approaching 60. Many are considering estate planning, retirement, and thinking about what is next for them and what is next for their farms. And compounded with that is the fact that many in the next generation are not necessarily sold on continuing to be operators. What we see to be a classic example, for whatever reason, and I would love for a sociologist in a PhD program to do this as their thesis one day. I don't know why farmers always have 3 kids, but we see it over and over again, that there's always 3 kids, and 2 are live 300 or 1,000 miles away from the farm, and have nothing to do with the industry, never farm, and they're ready to liquidate. And then the one sibling is emotionally tied to the farm, maybe as a farmer themselves. They want to hold that property forever. And it creates problems, especially for families thinking about estate planning. How do you resolve this? And so we actually see a huge opportunity there for us to be a solution as a flexible capital provider, because with the way that we're structured and how we syndicate deals, we can structure a deal where, we're syndicating 2/3 of the equity of the property out on our platform to equity investors looking to add farmland to their portfolios, and leaving 1/3 of the ownership with the one child who wants to continue either owning or maybe even operating the farm. And so that's a structure that hasn't really existed before the advent of crowdfunding, which is exciting. So all of that's happening on the supply side. And we actually, according to the USDA, have heard that upwards of 70 to 75% of all U.S. farmland is going to trade hands in the next 2 decades. So, I mean, we're talking over 500 million acres here. It's tectonic. And so, go ahead.
I was gonna say, when I think of farmland, I do think of the majority of it is owned by families and so forth. And, you're probably going to start seeing institutional and private equity and other investors probably jump in. And I'm just curious, how big overall is this market? I mean, you mentioned like 500 million acres, but from a dollar size, how big is, I know the mortgage market that I play in is, 30 trillion. But reality of it is, it's much smaller based on, the true market we play in. Just overall, just curious how big this asset class is.
In the U.S., farmland is about a $2.8 trillion market.
Okay.
And of that, only max 50 billion is under institutional ownership and management.
Wow.
It's a drop in the bucket.
It's like, a few percent.
Not even.
Yeah.
And globally, farmland is nearly a 10 I believe it's a nine something trillion dollar market. Call it 9.5. Globally too, we see the same thing. Institutional ownership and management is a fraction, simply because it's been held and managed in families for so long. And so, we see this as a tremendous opportunity, because, as you alluded to earlier, if in the next 20 years we don't have infrastructure for not only institutional investors, but also retail investors to come in and be able to invest in this asset class and enjoy ownership and enjoy all the benefits that this brings to a portfolio, your mind doesn't have to wander far to think about what the implications could be for U.S. farmland as an industry. How many acres would we lose to redevelopment? We're already losing substantial land. You'll appreciate this factoid. I think it was between 2000, I'll have to go back and check, but not a significant range. I think between 2000 and 2015 or 2010, somewhere within that time frame, we've lost twice the size of the state of Massachusetts in U.S. farmland.
Mm-hmm. Wow. Well, it's interesting too, because I know I've had some properties that, again, in the mortgage notes up in the Wisconsin area. And what they been saying, what's been going on up there is, these families have been, these houses have been just completely not taken care of and stuff like that. So what they've done in the past probably 20 years is they subdivided the property to have the farm as one and the house on the other. And the house is literally this little parcel, this big compared to this massive farm. And they would separate them, and then they were pulling the mortgages out on just the house. And then if something happened to the house, basically, it's like, well, that's the house. And then the farm would be in an LLC or some other entity that they couldn't touch. And, I think they've had some challenges with some farming in the last few years up in that areas. And that's kind of, hurt the market up in there. But it's just interesting because that's really the experience I have with farming when I was talking with an investor about that markets up in that area for real estate. And he said it was, hurting a little bit because of what was happening with the farms and how they were subdividing it and stuff. But one question I was going to ask too is, I see a lot of, so for example, I'll go down to Florida and I'll go to like Epcot Center, and, they talk a lot about the, farming and stuff and just new technologies. And I'm guessing too is, time goes on, there's probably new technology that can probably, without using chemicals, to enhance either production or harvesting and things along those lines to possibly bring some costs down to also maximize profits. Is that Is that true too?
Certainly. And, as a tech-enabled investment manager, we see that as tremendous opportunity on, not only just on the application side, but also on the varietal. And so when we look at permanent plantings, so permanent plantings are basically a section of farmland that relies on a biological asset that's going to provide a cash flow for several years. So typically this will be a tree like an almond tree, a hazelnut tree, or a vine, wine grapes, table grapes. And so when you think about those assets, every time you replant, you're planting a new varietal. And if you are being a diligent operator and manager and staying up to date with the latest research, the new varietals are incredible. I mean, we're actually doing an orchard now, a hazelnut orchard that we're selling through our platform in Oregon, and it's going to be replanted with a varietal called the Polio varietal. It was just released out of Oregon State University a couple of years ago, and this varietal is essentially pest resilient and blight resilient. It requires almost no inputs. And so just simply by using the latest and greatest in genetics in plantings of these biological assets, you can help improve the soil profile because now you're dealing with a hardier tree that doesn't need nearly as many inputs as some of the older varietals would.
I think most people, and I never realized this, which I shouldn't say most people, it's just me, but so my mother-in-law, she gardens all around our house and so forth. And I just honestly always thought, okay, just take the seeds, drop it in, throw some water, this and that. I never realized how much chemistry between chemical balance, pH and everything in soils, it's really an art, and it's an art form, which is interesting. So, and I think this is where some of these farmers who they've relied the last families hundreds of years on just their green thumbs and being able to do it, but also having some assistance from the tech side can probably also even further enhance and grow this business. I'm curious. I know you have in here. I'd love to hear your case study that you have, because I want to talk about the case study, and then I want to talk about, you mentioned this Oregon thing. If people want to invest in this Oregon or something else, I just like to run through that. But let's go through this case study, because I'm interested to hear how this works and how it worked out.
Absolutely. So this is Jupiter Farm. So Jupiter Farm is it's a dual commodity orchard. So we have both walnuts and almonds planted, and it's based in the east side of Tulare County, which is on the southern edge of California's Central Valley, where most of our tree nuts in the U.S. are planted and harvested. So this orchard was interesting because from a investor standpoint, a good portion of it was turnkey. So there's 54 acres of mature walnuts. They're planted to this variety that's called the Chandler variety, which is excellent. Basically, it's the walnuts that you'll find in the grocery store, the walnuts that most people like to consume. And then in addition to that, there were 16 acres of, again, going back to new varietals, the Independence almonds. The Independence are the latest varietal in almond production. And these were planted in 2019. So these almond trees are babies. Basically, for the first 3 years or even 4 years, an almond tree that was just planted won't produce any commercially viable yield. And so this was such an interesting property because we are able to offer investors cash yield from the existing mature walnut trees while giving them the upside of a development because those 16 acres of almonds are developing over the horizon. And as you can see down here, we have an estimated payout diagram if you were to have invested $100,000 in Jupiter Farm. And you see these first few years are about more or less, let's say $4,000. By the ending years, we're closer to 10 and then even above 10. And by the last year, 11. It's not because the prices of walnuts are projected to be, doubling in that time frame. It's because the Independence almonds are now mature and are a critical component of the cash on cash yield. So it was a nice way of offering both cash yield today while giving our investors also that upside of development. I can pause there I could talk about Jupiter forever, but I could pause there in case you have any questions.
So I was, I look at this and it reminds me a lot of, investors investing in an apartment complex that is a kind of, like 60% occupied that may need some, rehab and new leasing and so forth. It's in this instance, it's like you got some revenue stream, you're enhancing the property to get better revenue stream, you're getting cash flow during that time, and then you turn around and you're gonna basically in a period of time flip it and then cash out, and that's probably if you bifurcated the IRR, that's where you get most of the returns, which is typical in this instance. I'm curious, what are like the cap rates? How do you determine what to pay and what it would sell for? It looks like this one was a $2.4 million investment. So how'd you come up with that number?
Yeah, so typically we think of it as a almost if you look at real estate, you might think of a dollar per square foot or something along those lines. We think in dollar per acre. So
Okay.
I think when we look at this property, what we're essentially implying here is that over the horizon, we'll be able to capture about a 65% on a nominal basis appreciation. And so if I'm going off memory here, but I believe we acquired the property for, I want to say call it $25,000 per acre, $24,000 per acre, something to that effect. And I believe we're underwriting an exit of probably in the high 30s, which is market for a turnkey property like this. If we were thinking of what the lease potential would be and what cap rates would look like, a property like this, we'd probably be thinking of a cap rate around the 6% ballpark, 5-6%.
Okay. So cool. So what, and again, I know you get excited talking about this, so I am very interested in just learning more too. So, what was the factor as like, oh, this is a property to buy? Was there something that jumped out at you on this property? Was it kind of maybe a distressed seller? It looks like it had 54 acres already, so somebody was doing something. What was, I see it had, the riparian rights, which is probably a grand slam in this business for, especially, I know walnuts and almonds need a lot of water. So that's probably a key factor. But what was kind of some of the key points of this is, why would you tell somebody to invest in this deal?
Absolutely. So you hit the nail on the head. All of our underwritings basically begins with the things that you can't change, and you can't change Mother Earth. So we look at the soils and we look at the water. This property had class 1 and class 2 soils, which are excellent, and also had abundant water rights with riparian rights to the Tule River. We actually looked at we back tested what the property's water allocations looked like in the past and usage, and the property actually has a surplus of water, and so could easily and has sold back to the district when in previous years when it has not needed all of its full water allocation. So we screened so many properties out because unfortunately the soils have been degraded or the water is lackluster, and so it's unfit for investment. This property had, A plus water and soil, and in farmland, if we're sticking with the analogy of real estate, that's like being on a corner block of a beautiful neighborhood. You can't attribute enough value to it.
So one question, getting back to like the risk component, if it's a bad year, do you have, I know you have your debt obligations, but is there like operating expenses and stuff? So, let's take, say COVID shut down a farm, for example, you have your operating, your debt expense and so forth, but depending on how you structure these deals, is there the operating costs as well that could kind of, add to, some of that risk? Or is it basically, like you said, like you lease out the land and basically is that when this case is, did you lease this one out?
No, so we're directly operating this.
Okay.
So yes, we absolutely consider all of that when we take on debt. And that's, partially why we, at least at FarmTogether, we don't really look at high LTVs for these deals. So this deal was 39% LTV. I can't think of a deal where we've been over 50. So we try to keep debt very reasonable. And we also will build what we call a reserve or capital account, which is basically just extra cash in case there is, a global pandemic, which could influence the market and, in a negative way. But yes, we're confident on this property and all properties that we underwrite in our ability to service the debt. And I think that largely influences why the LTVs that we use are fairly conservative.
So you mentioned this is done by crowdfunding. Is there a crowdfunding platform that you use? And I'm just curious, like in this one, it looks like, there was a few $1 million investment and 40% was financed. So what's that, about $1 million? So about $1.5 million is probably what you raised on this deal.
Yep.
Curious if, is that people, what's the minimum investment? How much do people typically invest? And do you use like one of these platforms? Like I know one in my area is called like Fundrise or something like that. I'm just curious, how's that process work?
So we have our own native platform. So all the deals are syndicated on FarmTogether.com. And our minimum investment tends to be $15,000 per deal. That number's fluctuated a little bit, but between 10,000 and 20,000, it's never been more than 20,000. And I don't think, I think we are always trying to keep these as accessible investments, because ultimately our goal is to make this asset class more accessible. Average investments, vary by deal, but, plenty of folks, I think, are looking to, I think one way that they leverage our platform and the fact that we have a new deal at a regular cadence at least once a month, is they'll decide, okay, I think I want to invest 20% of my portfolio into farmland or 10% of my portfolio into farmland. That gives me X dollars, $200,000. Now I have the opportunity, because each deal is, it can be crowdfunded. I can do a $25,000 investment in this California citrus deal, and a $50,000 investment in this Oregon hazelnut deal, and another $25,000 investment in this Illinois row crop deal. And so you can build yourself rather easily a nicely diversified portfolio, diversified geographically across states, diversified from a commodity standpoint, over the course of a couple of months, and deploy rather quickly. And so we see plenty of clients taking advantage of that.
Okay. I'm curious, your projection for, call it this year and 5 years from now, how much are you looking to get out the door and get invested in, this fiscal year and over the next 5 years?
Oh boy, that's a great question. I would say, I don't know if I could put a number on it. I know we all believe at FarmTogether that farmland as an asset class is just, going back to that, to the data, 50 billion under management of a 2.7, $2.8 trillion asset class. There's just so much opportunity. So I certainly believe our hope would be to be managing a meaningful amount of capital over the next 5 years, certainly several hundreds or maybe even upwards of over $1 billion of retail investor capital, because we do think that there's great properties available and becoming available, especially over the next 20 years, since we know how many are going to trade hands now. And we also think that the asset class has proven to be one, arguably, in our opinion, a prime one for capital preservation. And so particularly in what we believe is going to be a chronic low yield environment, and, notwithstanding the fact that we've had this incredible idiosyncratic event that is COVID, and where rates are today, where rates may go, the potential for stagflation, the potential for hyperinflation. There are so many different macro drivers out there that could influence the portfolio, that we think having a tried and true asset class that, yes, it may not get you a 30% IRR, but it's very difficult to lose, to lose principal in an asset class like this. And so that's why we champion it and hope to make it as accessible as possible.
Well, yeah, I look at it from a perspective of, you know, you're acquiring this property. I mean, the land is going to have value, unless there's probably something catastrophic that happens to the soil. And from that perspective, it's like anything. You may have a bad year and so forth, but in the long term, these aren't, looking at these. I'm guessing your typical hold time is probably 7 to 10 years on something like this, or is that how you
Yeah,
underwrite
you
this?
hit the nail on the head. But another thing on that point that we find really exciting, I think alternatives have been historically, a difficult asset class for some folks to enter because of the hold periods. Not everyone has the luxury of being able to lock up capital for 10 years. So one thing that we're excited about, while we certainly underscore that farmland will treat you best if you hold it for the full horizon, because you start to get to enjoy that increased cash on cash yield and all the appreciation. If for whatever reason you do need liquidity during the investment, during the lockup period, we are actively going to facilitate a secondaries market, which we're excited to be opening this fall. And so the way our secondaries market will work is 1 year after each deal closes, we'll open up the secondaries market, and anyone who has invested in that deal who may be interested in liquidating their position can post that on our secondaries market. And on the flip side, if you're a buyer and you loved hearing about Jupiter and you wish you were in the Jupiter deal, you can go into the Jupiter secondaries market and see if there potentially is any interest that's available to purchase. So that's one way we're trying to also help democratize the asset class and make it a little bit less intimidating for folks who may not be ready to fully commit to a 10-year horizon should something occur during those 10 years where they need liquidity.
My head, and it's funny if people know me well, they know, like, sometimes the wheels start spinning in my head, and all of a sudden, so first thing that pops in my mind is, I've got 2 kids, and I've started creating self-directed IRAs for them, Roth IRAs, and it's like, okay, they're 15 and going to be 9, 10 years to them. It's like, who cares for them? They're not, my son will still be, if I had, he doesn't have 10 grand in his yet, but I mean, if my daughter all of a sudden had in 2 years from now, 20 grand or in an IRA, that's a Roth IRA, she'll be 17. You put that in there, she's not even going to remember that's in there. Then all of a sudden she's 27 years old. She's got something that has been vested in this for a period of time that's, like you said, non-correlated with everything else going on in the world today, and something that is added benefit to, from the social standpoint. So that's like where my head spin is, thinking, okay, self-directed IRA, people who are young, because what I see a lot of times too is, like, I had a call today with somebody and they were like, well, how long are your funds? And I said, usually only 2 to 3 years. And they're like, why are they so short? I said, because most people invest in notes, want that money faster. Apartment deals, you're 5, 7, 10 years. This type of deal, it's 5, 7, 10, because if you did it 3 years, you're probably not really going to have great returns. It takes
Absolutely.
time for it to build, and people, I think, need to understand that. But if you, like you said, you want to diversify on things, even people in their 30s, I'm going to be 45 this weekend. Hell, for, 10 years, I'm not going to be, living on an island yet with all my millions, but, it's something that to diversify and continue to grow. It's, at any age is still decent. But I mean, that's where my head's spinning is, man, I should get some of this stuff for my kids, because it doesn't correlate to anything from
Right.
some of these things. Cool. So starting to run out of time. So why don't we, first, why don't you tell us where people can find more information about you, some of these investment options. And I'm curious, do people have to be accredited investors, or can anyone invest in these types of things?
Yeah, absolutely. Great question. So to date, all of our crowdfunded deals have been structured under this exemption that's called 506C, which means that if you're a U.S. person, you would need to be an accredited investor. We are actively looking at alternatives for that. And so would definitely recommend if you're interested in farmland investing, even if you're not an accredited investor, visit our site, join our newsletter, and we will be the first to let you know as soon as we have a product that's open for non-accredited investors. But yes, our website, I think, is hopefully a one-stop shop for learning more about the space. We have a white paper there We actually also have a thematic paper on farmland performance during recessionary periods, which could be interesting for folks to see how it performed during the 80s, during the dot-com bubble, and during the great financial crisis. And then, of course, if you have any questions, that's our email, info@farmtogether.com. Happy to learn more about your interest and of course, answer any questions.
Yeah, and like you mentioned, the 506c, you have to be accredited, but there's other options out there, which I've done 506c, and I've also done a 506b, which is something you can't advertise, but you can discuss it with people who you have pre-existing relationships with. So if you start reaching out to FarmTogether, and I'm not giving financial advice or telling them what to do, and you start inquiring about different things and so forth, if an opportunity ever does come by, you can may have that existing relationship. So just because you're not, or eventually you may grow to that as well. So, but it does kick my daughter's Roth IRA out of that situation, unfortunately, but that's okay. Great. Any last second, things that you thought we should have covered that we didn't cover, in regards to anything, or anything else you'd like to comment on?
Yeah, one thing I think that your listeners would also find really interesting is something we find very interesting, and we're working on getting more of these types of deals on the platform. But there's a whole new area of farming known as regenerative farming that we are very interested in, which is actually, and can take many forms, but ultimately you're utilizing a set of land management principles where you can actually drive carbon sequestration through this type of farming. To the point where you can generate carbon credits from the actual farming. So we are super excited about this. Just a quick aside, but my background and how I fell into ag is actually my undergrad degree was in meteorology and climate. I'm a complete weather nerd. And so when I was thinking about careers, I thought to myself, what industry is going to be impacted by climate change, and what industry could be part of the solution for climate change? And ag sits right there. It's this very interesting and unique circular relationship where the way we farm influences the environment, but also it could be in a negative way, but it could also be in a positive way if we farm through using regenerative practices to sequester carbon from the atmosphere into the soil. And so we are working on underwriting a couple of regenerative deals right now, which we're very excited about. And we hope to be able to offer our investors on the platform some regenerative opportunities over the next couple of quarters.
One last thing that I thought of as well, just because of, I'm thinking, again, brain spinning, real estate and so forth. I'm curious, like the due diligence process, and we talked about the Jupiter one being next to water and so forth and so on, but I'm guessing too, there's probably process of, again, you still got to, review title, you got to make sure it's probably zoned for what you want to do. What are some of the other things that are kind of like, oh, wow, I would never thought that, or, as part of due diligence, or just what is that process? How long does it take also to kind of close a deal once you kind of start, getting it under LOI, letter of intent or something, to closing? Is it typical, 2-3 months, or does it drag on for a period of time because of the amount of due diligence you need to do?
Our process is probably identical or very similar to what you see in real estate. So we'll issue an LOI, we'll come to terms, and then enter into a PSA or a purchase and sale agreement. And under the PSA, we'll agree to our escrow period. And typically our escrow period is as short as 45 days on the very quick side to as long as 90 days on the longer end. And during that period, we're going to be doing a variety of different diligence tests and analyses. And our diligence checklist is actually, sometimes it grows over time. Right now it's 112 items. And so this spans from an ALTA title survey, phase 1 environmental, reviewing riparian rights, testing water quality, soil quality, doing a soil mapping, checking packing receipts for past years of yields to make sure that it's been as productive as we've been led to believe it has. We look at drainage and tillage. We look at I just blanked. I was thinking of Oh, right. This is more of my science nerd coming in, but we look at climate. I was trying to remember the name. There's actually a website called CalAdapt, specific for California, but you can look at how temperature change and precip change are modeled. So this is a 40 model ensemble that actually the International Panel on Climate Change uses. And so we'll look at what does the climate impact look like for the property. Of course, there's an appraisal done. That's standard in every deal. So, in many ways, I think it probably parallels real estate, but with some probably deeper areas in chemistry, because we do have to test soil and water and some of those elements. And then again, we believe that climate is a very important piece of the equation here. So that's more on our own side, but we do look at climate in each deal as well.
Yeah, I mean, it's similar to like my thought is, if you're going to go buy like a multifamily deal, you hire an engineer, you hire entities to go look at the HVAC, electrical. I mean, you have a forensic analysis on the building. Here, you're basically just doing that on the soil and on your asset. I mean, same thing. You're really just checking out the asset, and it's just a different asset. Last question I have for you, and then we'll wrap up. What if a developer comes to you and says, "Hey, I want to buy this land to develop it and build a mall or housing or something on the property"? How is that? Has that ever come up? And is it just your kind of corporate, your corporate kind of creed that it's like, "Hey, this is farmland and we're keeping it as farmland"?
Yep, we're not interested in that. So it's in our operating agreements. We will sell to farm managers. We are in this business because we want to retain U.S. agriculture as a strong industry, and not, I don't think we need more strip malls in the U.S. I think we need more sustainable farms. So, yeah, no interest in that.
And questions, sorry, just keep popping in my head too. Have you also, I'm just curious, ever considered putting any type of like sustainable energy, whether it be solar
Yes.
or wind on properties as well?
Yes, we love that idea and have been exploring it recently, actually. And when we do have properties that are good candidates for either a turbine or solar panels, we would like to add those and include them in the CapEx development budget. So we have not done so to date, but again, that's something that we look forward to doing on future properties.
Good. Well, David, thank you for joining us on this episode of the Good Deed Note Investing podcast. And like David mentioned, feel free to go to FarmTogether.com, get more information, or email them at info@FarmTogether.com. Final thoughts before we wrap up?
Thank you, Chris. It was a lot of fun being here, and I hope you have an awesome 45th birthday this weekend.
Well, thank you. By the time everyone listens to this, it'll be past, it'll be on our Facebook page tomorrow, but typically we're about a week lag to get our production company to post it on the podcast page. But thank you very much, and it's a pleasure having you. I enjoy, talking other investment strategies with people because, again, it gets my brain spinning, and I love notes, but I just love investing in real estate in general. So thank you for coming on. And again, everyone, please check out FarmTogether.com. Thank you.
Thanks. Take care.